Is it still worth buying property right now? Times are different from when I started investing 20 properties ago. So what if I were in your shoes and had to start investing today from scratch? In this video, I'm going to share my tips on what I would do if I were starting in property today, because the truth is, if you apply the same strategies used many years ago, you're going to struggle. You can still make money in property, but here are the things you need to be doing. Now, you get people all the time who say that property is dead, it no longer works, and if you're one of those people, I'm going to tell you straight, you're wrong. Right? Either you're doing it the old way, which, yeah, you could say is dead, or even worse, you're getting your advice from the newspapers. You should never pay attention to what the newspapers say, because they just never seem to make their minds up. I mean, just look at this fear mongering by the Daily Mail on the 5th of August 2022. The headline is Britain's buy-to-let and second homes bubble about to burst? But then check this. The same paper, Daily Mail, literally, right, 2 weeks later on, 19th of August 2022, published an article saying, are buy-to-lets back in business? But you know what? It doesn't surprise me, because that's what traditional newspapers do. They don't publish the truth. They publish what gets them more clicks to get more ads. So if I were looking to start building a property portfolio now, the first thing I would do is to purchase it through a limited company right from the start. And there's two main reasons for this. Let's talk about the first reason, which is your mortgage interest. So when I bought my first property in 2013 under my name, you could deduct your mortgage interest rate at the time. This means that if I rented that property at £4,000 a month, my mortgage was, let's say, £600, I'd make a profit of £400 a month, and technically be only taxed on that £400, which is fair. You know, you get taxed on the profits. That's how it works. But since 2017, thanks to this guy over here, George Osborne, Section 24 was introduced, which meant that private landlords could no longer deduct the majority of the finance costs, including mortgage interest, from their rental income before calculating their tax liability. This means that if you own a property in your name, you must pay tax on the gross income. So taking my first property as an example, instead of paying tax on the £400 profit, I would now have to pay tax on the whole £1,000, which is obviously going to be a lot. By the time I pay my taxes, there's barely any profit left for me. So that's one of the reasons. The other big reason is taxes. Let's say you're a higher rate taxpayer currently wanting to buy a property in your name, right? That would mean that any profits you make from the property, if you're lucky enough to do so, because, you know, we already know now that you get taxed on the gross income now, as we talked about before. But imagine you made a profit from one of your rentals, you would now get stung with a 40% tax bill on those profits, because that's what higher rate taxpayers have to pay, 40%. However, if you bought the same property through a limited company, you'd pay corporation tax instead, which is 19% instead of 14%, which is a massive difference. And to show you what a difference this makes, let me show you an example now. If you've got a buy-to-let that you're currently letting out for £950 a month with a £600 mortgage, you'll make a profit of £350 a month, right, before tax. And if you then times that by 12, that works out to your annual profit before tax of £4,200. You'll then have to pay £1,680 a year in income tax over here, which I've just circled, leaving you with a profit of £2,520. Now, if you bought the same property under a limited company, your rent will be the same, obviously, and you'd still pay tax on your profit, but this time you pay corporation tax, not income tax. And the 19% corporation tax works out to £798, which gives you a profit of £3,400, right? If you take away 3,400 and you compare the difference to the profit you made when you're owning it personally, if you just take these away, that's a huge difference of £882. And that difference, you're saving £882 simply because you decided to purchase it through a limited company and not under your personal name. We'll get back to the video in a few seconds, but 70% of you watching this video aren't subscribed to my channel. Please do me a favor and hit the subscribe button and buy more properties in the next few months. I'll be sharing everything so you can learn from my mistakes for free. Anyways, back to the video. So if I was looking to buy multiple properties and build a portfolio, I would buy through a limited company from day one. To me, it's like a no-brainer, because you end up paying less taxes, which means more money in your pocket. Obviously, speak to an accountant before you do anything, but whatever you decide to do, it's also important to think about your current situation and your long-term plans to go along with it. And because I get the question on Instagram and TikTok a lot, so I might as well cover that here as well, whether you can move your properties from your personal name to a limited company. Yes, you can. I did this with my very first ever property because I wanted to streamline my portfolio. But the things you have to consider are that you got to pay capital gains tax and you have to pay within 60 days. So that has to be accounted for. The second tax to consider is stamp duty. Then there's legal fees as well. So sometimes it might just be better to keep your properties under your personal name, okay, your existing ones, save yourself that money, and then in the future buy any properties under a limited company. As always, guys, it's all about the numbers, right? Whatever makes sense for you, you do that. So the second thing I would do right off the bat is use the BRR strategy, which stands for buy, refurb, rent, and refinance. Unfortunately, I made the mistake of not doing BRR on my first two properties, and you don't want to do that if you can, right? Because what happens is, what most new investors, including myself, of course, do is they save up a 25% deposit, right, which is a big amount, buy a property, rent it out, and then save up for a few more years, and if they're lucky, you end up buying another one. But the problem with that is that if you just buy and rent a property out, you now have to like wait several years for the property price to go up in value. And unless you've got more money lying in the bank, you kind of get stuck, right? Because you're now just playing a waiting game and you're almost leaving things to chance. When you want to make money, you can't do that. You need to take things into your control, and that's where BRR is so powerful. How BRR works is that you buy a property that's old and needs a lot of work to it. Usually the older the condition of the property, the better, because then you can buy that property below market value, and that's the important bit, to buy it at a discount. You then refurb the property and bring it back to a standard where the property is now at market value or even more. You then rent the property out, go back to a different lender, and then ask to refinance it at a higher value because you forced the appreciation. The lender will usually give you a 75% loan on the higher value because remember, the property has now increased in price from all the works you've done to it. You then use that money to deduct your costs of buying and refurbing the property, and if you've done it right, and you should do hopefully, then you'll have little of your money left in the property deal, and the money you've just got spare, you repeat the process where you buy another old undervalued property and you just rinse and repeat that process. And the reason why I love BRR, and I think anyone starting out should use this strategy, is a few reasons actually. Number one, you're going to get much higher returns than if you bought the property the old traditional way, you know, just putting 25% deposit down. Number two, you're going to leave a lot less of your money into the property, which means your money will now go further because you have more cash available to build your portfolio faster. Number three is that when you refinance, being as it's classed as a loan, not income, you don't pay any tax on the money you're able to pull out. And I guess the final thing is that unlike the old way of purchasing properties, you're in control and you're able to add equity instantly by purchasing below market value and then adding value by refurbing it. With BRR, you're not waiting years. Here, we talk in a matter of months. BRR is my favorite strategy, and it's the main reason why I've been able to buy 20 properties. And the beauty with this strategy is that you can combine it with buy-to-lets, service accommodation, HMOs, and many more. Next thing I would do is get my house in order by being better prepared. What do I mean by that? I'll give you my example. Yeah, when I bought my first property, I was so unprepared and naive about what it actually takes to get a property. I didn't know how it all worked, what kind of deposit I needed, or whether I could even afford it. One of the main things you need to understand when it comes to purchasing a property is your finances. So I would engage with a mortgage broker to see realistically what you can afford, how much of a mortgage you can get, and even what kind of interest rates you can expect to pay. I didn't even know what a mortgage broker was. I tried to do everything myself. So honestly, save yourself the hassle and time and get advice from a mortgage broker so you know exactly where you stand. And then based on what your mortgage broker advises you, it'll give you a lot more clarity about what you need to do. If they tell you that you can only afford, say, 150k mortgage and you were expecting 175k at least, you know now, and it gives you a plan of action. Either you start looking for slightly cheaper properties, or then you find a way to be more resourceful and find the other 25k to see how you can manage that. Also, start speaking to other people who will be important in your property journey. I'm talking solicitors, accountants, builders, and management companies. The better prepared you are, the more effectively you'll be able to pull the trigger on the purchase. Because the last thing you want to do is you've got all the finances order, you put an offer in, you have it accepted, but you end up losing out on a good deal just because you didn't have a solicitor in place, for example. So Start doing all these things beforehand so you're able to hit the ground running. So the final thing, which to be fair, I should have said right at the start, because if there's one thing I always recommend to anyone and everyone who asks me how to get started in property, I always say the same thing, which is get educated and build up your knowledge. The thing about getting the right knowledge is that you can get it from so many places: books, YouTube videos like this, podcasts, courses, seminars, mentorship, masterminds. There's so many options. Knowledge is widely available for every budget, so you literally have no excuses now. I personally started off with books and YouTube because it was easily accessible and it helped me a lot. I see so many people that get into property that don't do any of that, and they go in without the knowledge, just like I did with my first 2 properties, and you're just asking for trouble. Because the thing with property is that yes, you can make thousands and thousands of pounds in property, right? But you can also lose thousands and thousands. I know this firsthand because I lost a lot of money on my first property because I didn't have the right knowledge. So I bought a new build, I bought it in my personal, and basically every mistake I now talk about not making, I made, right? And then even my second property, again, I lost over £10,000 because I bought a property with a damaged roof. Looking back now, almost all the mistakes I made at the start could have been avoided if I just had the knowledge. There's a saying that if you think education is expensive, try ignorance. And it's so true, because if you can get the knowledge and avoid all the mistakes that someone else has already made, why wouldn't you take up the opportunity? I understand that education, especially in the property space, it's got a bad name, and it's simply because a lot of people are out there teaching things they haven't even done or they've done very little of. So it's also down to you guys to get educated by someone who's doing what they're saying, making sure they're legit. I mean, we've recently launched a program ourselves where we help people make a lot more money in property. It's only been recently since we've started doing that, but that's after sourcing hundreds and hundreds of properties for our clients, and also building a portfolio of 20 properties for myself, because I know how much people are skeptics of scams and stuff like that. So I wanted to earn my stripes before I even considered teaching. Anyway, I'm going off on a tangent there, but the point I'm trying to make is that yes, property is a great investment, but there is nothing better than investing in yourself. Every successful property investor, I can almost guarantee that they are where they are because they have educated themselves and gained the knowledge. The more you learn, the more you earn. It's just simple. It's a fact. The game has changed and will continue to change, and you as an investor have to adapt by keeping up with the latest knowledge. If you implement the 4 things I've talked about today, which are set up a limited company, use a BRR strategy, be better prepared, and build up your knowledge, I promise you guys, you'll be much further ahead in your property journey than I was. And remember, everyone has started from zero, so if they can do it, if I can do it, so can you. I have only got to where I am because I decided to take action, and when you take action, you create opportunity. If you want to build more of your knowledge and avoid some of the costly mistakes I made as a newbie investor, then I'm going to pull up the video called My £120,000 plus first property mistake. Watch that next, and I'll see you soon.